So thanks everybody for attending today's Meet the Investor. I know some people or a lot of people may be somewhat distracted about waiting for the outcome of yesterday's election, and it's something I'm certainly been focused on, and hopefully we'll have clarity to that soon. But today we've got Rob Arnold, or I keep wanting to say Bob Arnold, but I want to say Cole Younger. My apology. I don't know why I keep getting screwed up on that. We have Cole Younger with Arnold Venture Group, who was started by Bob Arnold. So there's a clarification. And it's really great to have Cole here because he's going to bring kind of a different perspective or a somewhat different view on investing, because he represents a family office. And it's really very similar to the way, the Coles family and Steve Rector and Sky Henderson operates here in Spokane. And so we'll have the opportunity to hear Cole talk about that. But the format today will be like it has been for other presentations like this. Is we're going to have Cole start off and kind of give a brief overview of Arnold Venture Group and what he's looking for and the history and those sort of things. And then we'll turn it over to questions and answers, and I will moderate that. But as always, I really encourage questions here from people in the group, particularly if you have a specific question regarding a financing that you might be pursuing sometime in the near future, or any other questions about interacting with angel and VC investors. So with that, I'm going to turn it over to you, Cole, and really appreciate you taking time out of your day to lead us through this.
Sure. And let me reiterate, if there's questions as we go along, just bring them up. I'm definitely here for you guys. And so feel free to ask questions as we go, or if you want me to clarify. Again, as Tom just mentioned, my name's Cole Younger. I'm the managing director of Arnold Venture Group. You'll hear me say AVG. Arnold Venture Group is kind of long to say, so just be prepared. But AVG is a family office, and for those of you that may or may not understand that concept, we have one LP, right? Unlike a traditional venture fund where you go out and raise dollars independently in multiple funds and many LPs, we just have one. It was started by a gentleman back in the early 80s named Bob Arnold, who has since passed away about 5 years ago. But Bob was an extraordinary person and made, between 1980 and about 2010, made a couple hundred plus investments into the Pacific Northwest. And those ranged in size, but definitely made a large impact into the Pacific Northwest. And so I've worked with Bob and his family over almost 15 years of my time. And so, my goal is to my job is to build on the foundation that Bob Arnold started. And that's a tall order for anyone, but it's something that we take pretty seriously. So a little bit about us, our mission is to empower entrepreneurs. I think that too many VCs out there are too caught up in some of the other pieces, and they forget that there's people out there trying to do extraordinary things, and we need to empower those people. And then that's how you get to the dream. We are, like I said, we're not a family office. We are a family office. We're not a fund. And so we can invest today and we can invest tomorrow and 6 months from now. Steve can appreciate this. Unlike a traditional fund where you can only make an investment, maybe they can't lead your next round because there's a conflict, or they've already allocated all the funds from that fund so they can no longer invest in you. We don't have that limitation. So we have the ability to invest today, tomorrow, and we just gauge what we want to do based on how the company is moving along. As Tom mentioned at the beginning of the conversation, we do have probably a little bit more patient view of the world as a family office, but I would also say we probably act in a very traditional VC way as well. But we're definitely, as long as you're growing the business, as long as we're growing the business together and it's up and to the right, we want to keep supporting you. And we don't want to look for a quick flip exit to improve IRR. We want to basically grow with you and get the best outcome we possibly can. We typically invest in the Pacific Northwest, which includes the Cascadia region. I'm sure everybody on the calls heard that more times than they want to. But, you know, primarily we look at Washington, Oregon. We do look in a little bit in California, and then we look in Idaho and Montana and some of those areas. Because our back office, we also have a back office in Chicago. I also look at Chicago, New York, and a number of other areas, which is unique for us because it gives us a very unique perspective on the entire country, not just the West Coast. We typically invest from pre-seed all the way through Series A, and sometimes into Series B and beyond, but we typically invest from pre-seed through Series A. Our ideal scenario is to be a seed investor and then to follow on from there, but we're not afraid to write the very first check into a company. And we're more than happy to continue to support that company through multiple rounds if they continue to grow. Check sizes kind of range accordingly. So probably from $250 in a really early deal, all the way to a couple $1 million and maybe a seed or an A round. So that's kind of gives you the spectrum that we operate in, and that's totally based on stage and our affinity with the business. So maybe how much traction they have or how the company is progressing. We typically target B2B software companies. So, you know, I would say that's our meat and potatoes, but we definitely have flexibility, like Tom mentioned, because we're a family office. We don't have an LP agreement that says, hey, you can only focus on one thing. So think communications, technology, infrastructure, no code. I mean, I can go down the list. There are definitely areas, but our primary driver is to invest in the very best entrepreneurs. So if the very best entrepreneur walks through the door and they have a really sound business case, I have a hard time walking away from that. But that said, we also have strong areas of interest, which would include, and you know, which would primarily be driven by the ability to unlock data. So we feel like our thesis is around, hey, over the next 10 plus years, you know, data is already out there and existing that's siloed, that hasn't been used, that hasn't provided insights that can transform businesses. So that's just one example. But because of that, you know, we're excited about applied data companies, right? Think AI meets data meets many evolutions, which allows people to have insights into unique businesses, right? Think about vertical industry optimization companies, right? So think of, in a specific industry, a company that might be revolutionizing that specific space. So in our portfolio, an example of that might be Wrench, which is a mobile mechanics business, right? They're revolutionizing the whole concept about how a mechanic works, right? And how that will evolve over time. Lastly, you know, workflow automation. You know, think DocuSign, right? Somebody that basically comes in and says, you know, horizontally, we have a piece of technology and we're going to work on that and get that workflow, an antiquated workflow, into a really smooth workflow that we can add a lot of value. So when it comes to data, there's a lot of different opportunities, but that's just one example how we think about data and unlocking those opportunities. But number one is we want to invest in the best entrepreneurs.
Okay.
So there you go, Tom.
Empowering entrepreneurs. That's a very solid mission. You know, Cole, how did you get involved? What in your background or your training? I mean, because, you know, to be an active VC like you are, you know, it's a unique skill set. How did you kind of get there? how were you mentored or trained or?
Yeah, it's actually a funny story, and I'll be brief, but so I was very interested in, I was at university, went to the University of Washington, which Steve Rector will not like.
That's okay. That's okay.
I went to the University of Washington.
Apparently, he applied to the UW though.
He didn't get in, but I was studying engineering and also business. So I got my engineering and business degree from the University of Washington, and I was very interested in how you could apply both sides of your brain at the time. And so there was a day that there was actually a class being, or kind of a clinic that was being provided, but it was only for students that were getting their MBA. So, and a gentleman by the name of Woody House was putting it on. So I waited till the lights went down and I snuck in the back door because I really wanted to understand what this guy was talking about. And he basically went on to teach about how venture capital is driving the American economy and how innovation is going to impact people in a positive way, and how the things that we're doing right today will not even be known for the next 5 to 10 years. And whether that's in robotics or drug development, you name it, in software. And so I came out of that and was so excited that I'm like, that's what I'm going to do. And so from there, I ended up going to work for a firm while I was in college, and that firm led to the next firm, and the rest of is history.
So it was Woody that inspired you?
Yeah, absolutely.
It's funny, he kind of had an impact on me too. I mean, just a classic guy and just a wonderful individual.
Yeah, and I think the concept is so exciting that, so for me, it's never been driven, and I know that some VCs have this stigma of, well, they're living this lifestyle of like, it's so exciting and they're going to make all this money. That's absolutely, if people said they wanted to get into it for that, I would say run to the door.
Yep.
Get ready for many sleepless nights. I used to have a lot more hair, right? It's not about that. It's about being willing to be super uncomfortable, and and then empowering people and really helping people execute their business in really difficult situations. I mean, that's the reality of our business. So
yep, absolutely. So you talked about the flexibility that a family office provides you, but my guess is a lot of people that might be on the call today, or others, unless they've really been through it, they hear your words, but they don't really know what it means. I really am a big believer in the distinction between family offices and traditional venture capital firms. Could you give maybe an example, or just clarify the points of differentiation that favor an emerging company that a family office might provide?
Sure. And this will be a bit of a brainstorm, but the reality is that everyone on the call understands a traditional venture fund raises money, and they provide a profile of what they're going to do, and then they go do it. Now, the negative of that is after approximately 3 to 4 years, they have to go raise another fund. And so they're always looking to the next fund. So I would say one differentiator is that in a family office, we tend to be very aligned with the entrepreneur because we want to see you grow a big business. So I'm not raising another fund in 3 years. And by the way, a lot of my good friends that are traditional VCs are going to not appreciate that comment, but it's true. Yep. And so as a result, there are times when traditional VCs are going to say, hey, we would like you to exit this business in year 4. And you're like, yeah, but we're right on the fringe. We could go with so much more. Well, let's go forward. They also, another differentiator, as I mentioned before, they can have conflicts between funds. So a lot of people don't realize when a traditional VC makes an investment in one fund, they're not going to make another investment in you in their second fund. That's just not the way it works. And in fact, because there's conflict, right? Are you cherry picking? How's it going to work? So that's just another differentiator that happens. And then many others include, we can invest today, tomorrow, and the next day, and we can lead that way. A traditional VC, if they have a fund conflict, may say, no, our policy is after we make our investment, an outside source must come in and lead that next round. Yep. Now, that's in, in quotes. The reality is when they have to lead, I think a lot of VCs step up and do that. Or if they're very excited about a business, they may compromise on that. But that's really just a few differences between, I think, a traditional VC and a family office.
I think really one of the most compelling one is your ability to hold an investment for truly a long period of time to optimize the outcome. I had an investment once in a company in Seattle, one of my most favorite investments, and I'm not going to bring it up because I don't want to implicate the venture fund I'm referring to, but the company had been in the portfolio, or my portfolio, for maybe 10 years. So it was a little long in the tooth, but the company was just hitting its stride. But we made the decision to sell the company solely because it was the last legacy investment in that VC fund, in that fund of that VC, and they had to liquidate and wind down the portfolio. So we sold it for, not really a compelling exit. If only we would have held it for maybe 3 or 4 more years. So it was an unfortunate decision just based on an artificial holding time frame of the VC firm. But Anyway,
Yeah.
we'll move on from that. One thing I really like about you, Cole, because I think you and I and Steve and kind of view the world as investors in a similar way. And that is kind of the balance between how much of this is art and how much of this is science. And how would you, when you look at a deal, how much of it is just kind of analytics and data and number crunching and Excel spreadsheets versus just kind of a gut reaction that you have that, what, this is worthy of making an investment?
Yeah. So and by the way, I think this, Tom, is a sliding scale. So meaning when you're early in your career versus as you get later in your career, because you've seen the show enough times that you understand it. But I think similar to many other jobs, whether you're a plumber or you're a VC, you have to have a set of skills that allow you to do the job. And so to your point, the analytics, understanding, all these other pieces that you just have to have. And those are not things that I think those are just science. Like you develop that skill and you execute on that skill. But I think the art component is significant. And what I mean by that is you have to have the ability to correlate market conditions to people and ideas. So you could be too early on a deal and the market's just not ready. Yeah. You could miss on a person because they're brilliant and you have a great idea, but they just can't execute a business, right? And you can't work with them in an effective way. So I think the art component is your ability to work with people, read people, and then correlate that to market conditions. That's really the art of what we're trying to do. And then, but I don't know, as I mentioned, Tom, I don't know what percentage that is. I think it's 50-50. And I think as I get older, that number will continue to favor the art.
Yep. So let me maybe ask it a little bit of a different way. If you were kind of, boil down 3 key predictors of success of a company that you might be looking at, what might those be?
Yeah. So let me think about it here. So a couple things. Let's first kind of qualify that question. So, because you kind of have to. First, so if you qualified it like this, assume it's a very large market opportunity.
Yep.
Assume that they're tackling a very valuable problem to solve, right? And assume that they have a sense of product market fit. Okay, so if we just make those assumptions, Tom, then the 3 most important things in any deal are team, 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 all 3. And the reason I would say that is your team has to have a founder and or a person involved in the company that has deep domain knowledge of the market. Because the only way you can iterate quickly and make a quick move or solve a problem in a unique way is to understand that problem better than most people. Mm-hmm. So deep domain knowledge is one. Team, again, you got to have leadership. And I've seen this so many times that can inspire others and attract talent. So, I am always looking for that person that is very okay with not being the smartest person in the room. Yeah. The best ones that I know, a guy named Jake Weatherly at Sheer ID. Steve, I know knows him. He has the ability to, that's a portfolio company of ours. He has this ability to attract really high quality people around him. And he has a very, high EQ, IQ. And I think that's so important. The third one would be, and I also see this, is their ability to the leadership team be obsessively curious, right, about their business, even over a long period of time. Even when they have success, they keep iterating quickly and they keep having this curiosity and then embracing feedback. Yeah. So a lot of folks want to be the smartest person in the room and don't listen. And a lot of times it's just feedback that they get to choose to take or not. But if you are always the entrepreneur that says, no, I know what's best, I know what's best, I haven't seen those entrepreneurs be the most successful. I've seen the ones that say, oh, thanks. Let me work on that and get back to you. And they come back, and often they come back with brilliant ideas.
Yep.
So that's what I would say the 3 are.
Okay. And it kind of comes down to team. You have, would you back, because you guys are involved in pre-seed and seed, would you back a company that only has one founder?
So you notice I said team, not individual.
Right.
But here's the thing. I would back one if that one has the ability that I mentioned in terms of the ability to attract others and that really high EQ, IQ, because, you know, we all have scars. I have them. You know, I've backed a phenomenal CEO and the investment ended up being, you know, not a positive by any means. I don't remember what our return was, but we would have been lucky to get our money back. And I don't think we did. The reality is he was a phenomenal CEO, but he needed to be the smartest person in the room. He needed to control those around him. And I just see leadership as bringing everybody else past you just makes your company stronger. So to your question, one individual, that's a high risk. So I'd have to be comfortable that they could pull it off. Right. That's why we like teams so much.
Yep, I agree with you. I mean, I would never say never that I wouldn't back just a sole entrepreneur, but it's so difficult to start a company, and to do it by yourself is a huge challenge. Yep. Another kind of interesting question though is, and I run across it a lot, and I violated it with the mixed success, but what about backing husband and wife teams?
Oh, that's a great one. Yeah, we almost emphatically don't. And so now I have broken that rule. But, and again, I'm not opposed to looking at those companies, but we almost emphatically have not pulled the trigger on those companies, sometimes because, you know, there's so much adversity already in deals, right? In a company early on. And there's so much, you know, adversity that they're facing. We would be open to it, but I can't tell you that it is something that we historically have done.
Yep. We have, along the lines of that, we have a question from Naomi. Naomi, do you want to ask your question?
Yeah, sure. Thank you for giving me this opportunity, Cole and Tom. So what about investing for a part-time CEO founder, because we want to save money and we don't want to use the money. We haven't raised enough capital, so we don't want to waste our money like paying for our CEO and co-founder. We are saving so that the co-founder is a full-time co-founder, but the CEO is like working on a part-time.
Well, Naomi, that's a great question. I think it comes down to where's the business at. So if you want to have a venture fund invest in you, or family office venture fund invest in you, you likely will have to get to a point where the company has that full-time CEO. That does not mean that that's not a good call on your part in terms of helping that business along and getting it to a point where you're now ready to say, hey, I'd like to bring us all on full-time. But you know, almost every single company we invest in does have a full-time CEO. And that's partly because we want to see that company execute at a very high level. But that doesn't mean that earlier in its evolution, they were doing exactly what you're talking about and bootstrapping the business to a point where they could go out and raise those dollars.
Thank you so much.
Perfect. Your discussion about the teams has also elicited a question from Scott Cook. Scott, you want to fire away?
Sure thing. So I was just having a discussion this morning with another entrepreneur in the Spokane area about how we're just not sure if investors, you know, investors talk a lot about how the quality of the person is equally as important as the product. But we were discussing, well, did they ever take them through personality tests or the Enneagram or any real almost personality gauntlet to make sure that you, the investor, know who it is you're investing in versus just a gut feeling? And we're just kind of curious what type of vetting you go through as you work through the person you're dealing with.
Yeah, so that's a great question. Yes, if you look at a lot of firms, they absolutely, not only do they put them through tests, sometimes they also hire full-time folks that their job is to make sure that they're watching those people and often assessing them and then beginning to mentor them in the areas that they may have weakness in. Now, that doesn't mean in terms of, if you're asking me an ethics question, I think that one is always a gut feel. But I think when certain personalities can be assessed. Now, for my firm, this is my 20th year doing this. And so we don't use a formal test by any means, but having spent a lot of time with a lot of entrepreneurs, I'm usually looking for some very specific things. Does that answer your question, Scott?
Yeah, it does. It prods a second question. What types of things specifically? I imagine everybody's kind of got that one or two, like, oh, they've got it. What is that for you?
I'll give you a couple fun ones. The first one is that if I wouldn't have you to my house and sit down with my family to have dinner, I'm probably not going to invest in you.
Did you steal that from me, Cole?
I know I gave that to you, Tom.
No, I've been saying that for years.
No. That's one.
We'll take that offline.
The other one that I would tell you is that is probably less, and I know Steve knows this, and Tom, I say it. I want entrepreneurs that have this drive where they get up in the morning thinking about their business and they go to bed thinking about their business. I want them to be so tenacious about it that they literally will not refuse. They just will not lose. And I mean, to the point where, and I say this and don't, we are recording, but I'll cut my fingers off to win. And I know that sounds politically incorrect, but what I'm saying, and that's just figurative, what I'm saying though is your tenacity, you will do anything it takes to be successful, because there's so much adversity in raising capital and bringing a product to market and dealing with all the things that, HR issues, all these things in life that unless you have that tenacity that I'm unrelenting, I think it's hard. So that's one that I kind of hang my hat on. But again, just figuratively.
I like that. Thank you. I appreciate it. That's encouraging.
Fantastic. Hey, we've talked a couple times about your answers to a couple of questions have been in the context of a stage of a business. And there seems to be, as I talk to people, kind of confusion about, what's pre-seed, what's seed, what's Series A. Could you kind of, enlighten us in terms of, your definitions of at least those three early stages of a company's development?
Sure. And just for context, when I started my career, there was no such thing as seed. So in 20 years, we've gone from the first round was really Series A, and the rounds were likely in the order of 250 to 500,000 in that round, right? To where now, even in a pre-seed deal, you'll see where they're putting dollars up to a couple million, $2 or $3 million in a pre-seed. So FYI, things change all the time. But if I think about pre-seed, here's how I see it. I see a pre-seed deal as pre-product, right? You're really betting on some individuals that have a concept. They're pre-revenue. The team is comprised of just a few folks. There's no idea in terms of product market fit yet. So they tend to be very bright people, good, hopefully repeat entrepreneurs. And it's the first dollars they're taking because they say, look, I have this, I've been out researching this for 6 months. I now have this concept. I'd like you guys to back me. That's kind of, that's how I see a pre-seed deal. A seed deal, I think now you have your core product built. Your team is beginning to expand beyond, maybe now you're at 4 or 5 folks. You have pilots in place. Maybe you have even a little bit of early revenue in place, but you're fine tuning the product market fit. So now you have pilots or beta customers, and maybe even beginning to get that revenue generator moving, but you're fine tuning the product market fit. Your model is not all the way there, or you had to enter a market with it not all the way there. So now you're really trying to fine tune it. So that's how I would see a seed deal. A Series A deal, I would be say that in today's world, the team is fundamentally there. So not your whole team, but your core team has now been built out, right? Your revenue is ramping, and you have the ability to kind of forecast that now, right? Your product market fit is no longer a question whether it's going to fit or not. You figured this out and people are willing to pay you. Now it's all about, okay, how do we replicate this in a scalable way? So what I mean by that is most entrepreneurs don't realize when you really want to grow a business, you have to make some big investments into your internal infrastructure. And what I mean by that is usually people and processes. And so now the Series A, in my view of today, is really scaling that effort. So I'd say those are the three.
That was perfectly well explained. And I hope people on the phone that are contemplating raising capital took notes there, because that was a fantastic explanation.
And by the way, Tom, I learned that from Steve Rector. So,
well, I think I passed that on to him. So it's kind of a full circle here. As you can might tell, Cole and I and Steve all work closely together and have a high degree of mutual respect for each other. So if there's any teasing involved, it's only in good nature. But because, oftentimes I find people using the labels seed or pre-seed or A to kind of explain how much money they're trying to raise rather than really where they're at. Now, having said that, you've given a great explanation of kind of the components of those three levels. What would be the general kind of range of amounts for a pre-seed funding, a seed funding, and particularly Series A, because I'm just shocked by how big Series A financings are getting now, because back when I was doing this 20 years ago, a Series A might have been a $1 or $2 million, but that's not the case anymore.
Well, and just so you know, I mean, crazy things, Tom. I was on the phone yesterday with another VC, and we were discussing stuff that they're seeing in the Bay Area. And he was sharing with me that they're seeing deals that are Series A that are 75 to 100 pre, just to give you a sense of crazy. So, and some of those, are just huge rounds. I'm going to probably have a hard time giving you the right numbers.
Yeah.
Pre-seed deal, I think I kind of look at it like it's $1 million plus or minus 500K either way. So pre-seed, it could be less, but when I think of a group of investors, often what happens is, hey, we really like this business. 2 or 3 investors kicking, 150 to 300 a piece, and you're at that, go execute for that period of time. Because remember, it's correlated to time. Yeah. So it's really to go out there. Why are we raising the dollars? We're raising the dollars to achieve a milestone within a specific period of time. So that usually can help them with their burn rate. If they're burning, 50 to 100,000 bucks a month, that'll give them the better part of a year to get at least the concept going. Seed deals, you could anywhere from a couple $1 million to probably, who knows, but that $5 to $7 million range is kind of what I'm seeing.
For a seed round.
Sometimes, yeah, sometimes. And so seed rounds have gotten really, really large, and we can go into the reasoning on another day, but one of the reasons is just that large funds are trying to move downstream into those deals. So funds that were traditionally B, or A only, they're trying to get into seed deals now due to access. They have a problem with allocation, and so they have to try to put more dollars in early. So if you're an entrepreneur, don't get talked into that. And then I would say the A in today's world, I would say can be anywhere from probably the end of what I mentioned before, that 6-8 to all the way up probably to pushing 20, 25. And so, and we didn't get into valuation and assessments, right, but that's highly variable. So yeah, so that's where I would say those numbers are. But again, highly variable. Take all those with a grain of salt. I think it's more important to talk about where your business is and what the needs of the cash.
Absolutely.
So yeah.
So which kind of brings up another question that I don't think you've addressed, which is, I presume you're leading some deals, maybe the early stage seed deals and pre-seed deals, and then co-investing with others on the later end. Is that a fair characterization?
So a couple of things. When we talked about pros and cons for VCs versus traditional family office. So one benefit that a VC has is if you have 6 partners or 5 partners and they have a whole big group of people, they can lead more rounds because they can do more deals that way. So because my specific group has a back office of folks, but it's relatively small, and I am the managing director and I have to do all of it, I don't have the bandwidth to go lead 4 deals a year. Just doesn't happen. Yeah. So we would much rather co-lead a deal with someone or syndicate around with someone. Now, the former doesn't happen all that often. We're happy to lead in certain situations, but there's just a real scale issue associated with trying to lead and then be on the board of all these companies. Yep. And that brings up the other point. We don't mandate a board seat. We always typically take observation rights. Yep. And the reason why is we want to make sure that we're adding value, but we also, to my earlier comment, we want to put the best person in that seat that we can to help you in your next round.
Yep. We have a question from Nick McLean. Nick, fire away.
Yeah. Hey, Cole. Nice to meet you. I was wondering, so you were talking about, you know, in terms of like seed and Series A, that it's always, you know, about the time, I guess, until the next round, especially if the company's burning cash. How long do you think that should be? I know what Tom thinks for, you know, the number of months after he makes an investment, but I'm curious of what you think.
Are you getting a second opinion, Nick? Is that what you're doing?
I'm just trust but verify. Trust but verify.
Well, it's a good question. So, and some of it has to do with where you are in terms of the stage of the business, right? So we're going to just take some averages, but the reality is that you're a very different business when you're in a pre-seed deal than if you're a Series B deal. So I like to think about 18 months of runway is if we were looking at a seed round and they said, hey, we're going to raise 18 months of cash. I like to think about, so let's go back and talk about why we're raising money. We're raising money to achieve milestones. So I'd like to see that you can, in your plan, achieve the result that you're looking for with an additional almost 6 months cash, because there's going to be bumps along the way. It's going to take time. And so 18 months, I am seeing rounds that are, we have over 2 years of cash now and some of these things. And I think if I get below 12 months, I get uncomfortable with that. And so because there's just too many things that go wrong and it does take time. The issue for you is going to be around, Nick, how much dilution you want to give up. And so, yeah, you could have 48 months of cash on hand, but I don't think you want to take the dilution at that stage that might happen. So I guess that's how is that close to what Tom said, or what did he say?
It's pretty close. Yeah. And do you typically lead, or are you hop in after someone else leads?
So like we were talking about, we're happy to lead in a certain situation. I just can't scale that many deals that way. So we prefer to either co-lead or to participate in the syndicate. So
sure. Okay. Thank you.
Yeah.
We have a question on this topic from John Garrison. John, do you want to ask
John Garrison.
Sure, Heckle. Look, I'm always interested on the valuation side of the equation, and obviously that varies largely from business to business, industry to industry, market you're trying to hit. But when you're talking about $1 million pre-seed, what are you typically using, or where are you typically taking ownership percentage on something like that? And I know there's not a typical, so just looking for, broad brush here.
It's a great question, and within my own colleague circles, this is a hot topic. I am not hard and fast on ownership percentage. Earlier in my career, I would say I would say, well, if we're going to come in, we got to have this. I think I care more about being in the right deal than I do owning the majority of the round. And so the reality is that if I give you any answer, it's going to be wrong. And the reason I'm saying that is the variability on valuation is huge. And so it really is a deal by deal situation. And $1 million seed, I mean, I see those deals getting funded a lot of different ways. They could have a convertible note. They come out and just say, we're just doing a note because we don't know. We could have with a cap. And so, or they might come out and do a safe. I'm not a big fan of safes, but they might do that, right? Or they might price the round. And so, but I mean, I'm seeing everything, just to give you a sense, from 4 or 5 million to a pre-seed deal, pre-seed to 12 to 15 pre-seed.
Sure.
So that's why I'm hedging here on the percentage ownership. That's too big of a percentage. I mean, at the end
I think that's accurate. So actually, that's quite helpful.
Okay.
I think people fail to realize what does it take to, build a full startup, right?
Yeah.
And so I think what you're talking about makes sense to me.
Well, and just know that I say this all the time. It's more important if I'm the entrepreneur to have the right people that are helping empower me to do this, and that I have necessary cash to go execute against those milestones, than to be concerned over $1 million in valuation. I've seen VCs and entrepreneurs walk away from deals over almost nothing. And in the end of the day, they ended up picking another partner that was terrible, and the whole thing blew up. But if they would have went with the right partner, they wouldn't have been too concerned. And I often see in young entrepreneurs, they're very, very concerned about ownership percentage. I have to have this, and they're willing to fight you. And at the end of the day, that's not a good move. The best move is to say what's reasonable so that both of us can live with this.
Right.
And then if you're going to take a little bit of extra dilution, but instead you had 18 plus months of cash, you need to think about doing it, especially today in today's world, right?
Thanks.
Okay.
This is incredibly valuable advice you're getting from Cole. And one thing I often tell people that are seeking to raise capital from venture investors is that it's really important to have the right person, as Cole is saying, represent your company and be the person that is either on your board or a board observer. And it is so beneficial to have someone with Cole's experience be on your team, because the things that Cole is saying, you don't learn right out of the box in the first 3 to 5 years as a VC. So if you're raising capital, and you have the chance of having someone with, I'll say, kind of 20 years of experience that has seen everything and can have more of a textbook understanding, your company will prosper a lot more. Because I mean, the advice that you're giving, Cole, is just so steeped in experience and having been with a lot of companies. And
well, and Tom, I appreciate that, but it's also steeped in scars. So,
yeah.
I got to remember, always just being willing to, like, as I said before, getting on the oars with you, right? Yeah. I mean, you got to check your ego at the door. So this is for the entrepreneurs. You want an investor that will check their ego at the door and just get in there and help you. But at the same time, you got to be willing to do it too. Yeah. And I think that's, if I could say one thing to them, that is it, is find the right person, check your ego. Because if you check your ego, valuation, you're not going to live and die on a valuation.
Right.
You're going to look for substance. And so what can you do to help me with my business, right? How can you help me take it from A to B? And so that's what we should really be talking about, but we often don't. So. Yep.
And I share the scars. We have a question from Dan Rourke, as it might relate to, acquisitions as a partial growth strategy for companies. Dan?
Are you saying, Tom, roll up strategy?
I'll let Dan ask the question.
Okay.
Yeah, essentially. So I'm curious, like in your portfolio, do you have examples where you've helped, provide additional capital to take a bigger position in a market? So, a roll up sort of mentality. And then also as a follow-up to that, with your hold mentality, how many companies, how much money do you currently have invested in groups today, and how do you manage all that? So kind of a two-part question.
Yeah. So in terms of the roll up, I'm not a giant fan of trying to go grow your business through doing 70 acquisitions, right? And to put those together. There's obviously a lot of investment banks that do that for a living. But young companies, I think it's all about doing something really well. I definitely have companies that acquire other companies. And so it really comes down buy versus build. So if I see that you have a small business and it would augment our business or fill a gap, and I can buy it from you, you're happy to sell because you've got it to here, but you're kind of tapped, or it's not what you want. We love acquiring businesses like that into our existing portfolio companies. But if someone came to pitch me and said, here's how I'm going to grow this business, I'm going to acquire all these other businesses, I would probably be more hesitant. And the reason is the dilution associated with every single time we do that is significant. So I hope that answers your question.
Yeah, more interested in strategic bolt-ons than, an industry roll-up position.
Yeah. So I mean, I buy versus build. So it all comes down to, like, if you can be in market and you could be like, and you can take that base business and layer your business on top of it and basically go 3x in 2 years or 4x in 2 years versus you building it yourself, and maybe you get 2x, I'm fine with it. But there's risk. There's a lot of risk in bringing other businesses in. So they always look really nice, and then you buy them.
Yeah. So. And then in terms of, like, how many companies are you guys invested in today? How do you manage that, I guess, is a question. So you keep things longer than, say, VCs was your comment.
Yeah, and I want to make sure I want to make sure we're clear on that too. I mean, we have very similar expectations of a VC. I'm just willing to hold it longer as long as you keep creating lots of value. right? So we're not going to let a fun constraint, as Tom gave a perfect example. They got the out at the end of it and just forced it, or they want to see the quick flip, so they sell it. So in terms of dollars, you know, we have, I don't know how much of that is proprietary and how much I can share, but I would say that just to give you a sense, you know, we have less than 20 active companies, but that I still manage a very large additional portfolio of companies, significantly bigger, additional companies that we take care of in our legacy portfolio. So I'm looking to add, Dan, to your point, usually between 2 and 5 new companies a year. That's why I can't lead all the rounds.
Yeah, cool. Thanks.
Hey, you mentioned that you don't like safes and
Well, yeah.
And I'm not necessarily a big fan of them either. And so what am I mean, and also same with convertible notes. And I personally am not a big fan of convertible notes and will only do them if I kind of have to. But I'm kind of interested in your views on that.
Yeah. So if I have my druthers, I will always take a price round, period, because we know what we're buying then, right?
Yeah.
And I can say, okay, is this worth it or not? Step back into convertible notes. Convertible notes are fine. And a lot of investors would say, well, I'm fine doing a note because it has a change of control provision or something in it, so I'll get something. But that only really works. The variable there is time. So if I get stuck in that note for 18 to 24 months and you develop all of this, but it only has a 20% discount, I lose.
Yeah.
So I guess I would say I'm more interested in price rounds than convertible notes. The only reason I don't like the safe is great from an economic standpoint early in a company's, you know, right in the beginning of their evolution. I don't have a real issue with that. If, hey, we raised $250,000 and we just put it together quickly, and then it was very economical because it costs a fraction of what a convertible note would cost to put together. But we fully intend to raise money in the next 6 months. That's the right, in my views. Now the world has taken that, and now I'm seeing safes that are enormous. I saw one the other day, I could not believe it. It's just enormous, and it doesn't make a lot of sense. So I think it's the wrong tool for the job. So is that helpful, Tom?
It is, and it coincides with my own personal views as well.
Okay.
So we have an interesting question here from Eric Nelson, but Eric says he's in a loud place, so he wants me to ask the question. But after you've made and this is really, it's a very insightful question. I look forward to the answer. After you've made an investment and you're on the board or a board observer, you know, what are some of the early warning signs, the pink flags, so to speak, that things aren't going quite right? You know, probably not, you know, not something that's just really obvious, but things that you might walk out of a board meeting and say, you know, that didn't quite add up.
Yeah, so that's a good question. I would say VCs don't mind bad news. They don't like surprises.
Yeah.
And so what I mean by that is if I have higher expectation for our companies, even if you're an early pre-seed seed company, that your financials are really clear. And so there's no reason why sometimes here, well, we're so early, we don't do that. And I'm like, well, then I guess we're not going to invest, because the only way you can be a strong operator is to have really good control of your financials, which allows you to dictate how much runway you can control. I see that sometimes. And so that would be an early warning sign to me that we're in a deal. They said they could do these things, and I've even seen some maybe, and now I'm looking at their financials and they don't really add up, or they're so aggregate in a PowerPoint slide that I'm like, hang on. As an entrepreneur, you want to make sure you're building credibility from my perspective with your investors. So you want to give them really tight numbers. Doesn't mean you need to give them massive spreadsheets, but what you present is very clear. So that would be one for me. Another one is when there's issues within the core team early. And so if I'm seeing that, you know, back channel that we're finding out that they're losing a key member, or there's a little bit of a difference of opinion on how they should go, that's a concern, because they should disagree. Hey, we're going to do this, but they should have the mutual respect to always come back together as a team and move forward. But if the entrepreneur is saying, well, no, I'm going to take my ball and go home, that's a problem, because that is an insight into how they see adversity and how they deal with it. Yep. How can you grow a huge business with that perspective? So there'd be two examples.
Yep. You know, one of my early warning signs is when I might, either in a board meeting or outside of a board meeting, ask the CEO, hey, how's the third quarter coming along in terms of revenues or margins? And they go, oh gosh, God, let me check with the CFO or the controller, or let me get back to you. Because back to your tenacity point, if the CEO isn't worried 24/7 about hitting his or her numbers, and they can't tell you mid-quarter where they're at, to me, that's a huge warning sign.
Yeah, I would emphatically agree. Remember, the CEO should always know, right? Yeah. It's your job to know. It doesn't mean that you're putting all of it together. It doesn't mean that you're on every call, yeah. But you need to know. And so I would absolutely agree. Or Tom, add this one. Don't give anecdotal success points as the actual success point, meaning, hey, I had a really good call with this group. That's great. But if you come back and tell me that, and then come back at the meeting and you didn't come close to what you were trying to do, you just sent me a mixed signal. So I like everything to be really straightforward. And again, back to my earlier comment, bad news is okay. No surprises, please.
Yep. So. And then on your back channeling observation, one of the calls I hate getting, and I want to know how you react, is when someone within the company, maybe a mid-level person, calls up and says, hey, Cole or Tom, I want to tell you about this. Yeah. And it's generally something that's bad and it is troubling.
Yeah.
And what do you do when you get those calls?
Yeah, that's a very straightforward one for me. Hey, I invested in your team. You probably need to have a conversation with your CEO and the group, and we can discuss it. One thing we cannot do is ever have team members undermine those around them. Now, that doesn't mean if there was, negligence, someone's, something that was really terrible that you need to let the board know. But I do not appreciate, and I would not want to be part of something where I have a mid-level person telling me things that they don't like, because that just means the team's not cohesive. Yep. So it's either that person's a problem or the leadership has a problem, both of which are problems.
Yep, it's a very, very awkward situation. Yep. Hey, in the last 5 minutes here, I kind of want to transition to kind of two topics. One is kind of the current economic environment with COVID or anything else that might be going on politically, and what, this is kind of a 3 or 4 parted question, but what advice are you kind of giving to companies right now in this environment? Is now a good time to start a business? And then, the last is observation on companies in this or the Spokane region as being, a potentially attractive place for a company to start a business. So a lot of stuff in there, but I think you get the gist of my 3-part question.
I get the gist. So I think, let me try here. So first of all, if I was going to tackle what advice am I giving our companies in today's world and dealing with COVID and dealing with all the things that are going on, my advice is you must find a way to thrive in today's market. Don't wait for it to get better. A lot of folks are coming out saying, well, I think we're okay, but we're just going to have to wait till this and then it should be back. I think you don't. That is not the advice I'm giving my company. This is your new normal. Iterate quickly. If you see opportunities, be bold, adjust, pivot the business if you have to, because those that sit there and just don't do anything run the risk of not being in business. So that'd be my answer to your first question. I think the second question you asked me was, is now a good time or a bad time to start a company? I think this is a phenomenal time to start a business. If you look historically, dislocations in the market have created some of the biggest opportunities. Even when I say dislocation, that could be change or even very bad economic times, which is not something we've really had. So if you think about it, I would throw 2 names out to you just to give you a sense. Those of you on the call have probably heard about a company called Disney. It was founded in 1929, right? Probably not the greatest timing. Another company I'd throw out that more people know, Trader Joe's. Trader Joe's was founded in, I believe, the recession of 1958. And, now it's a multi-billion-dollar business. So those are just 2 examples that you don't have to wait for the perfect time. You got to go find an opportunity and get it. And then the last question I think you asked me was around, do I like Spokane, and is Spokane, or maybe the pros and cons of Spokane as an ecosystem. You know, Tom knows I'm a big believer of Spokane. Steve knows it too. I think as an entrepreneur, if you're in the Spokane area, it's a phenomenal place to start a business. And here's why. First of all, you have a lower cost of living. So your overhead for your business, you can do more with the dollars you have, right? The second thing is high quality of life. I mean, it's an absolutely beautiful area to live in. So those two things are absolutely in your wheels. The other thing that they don't realize is less competition for dollars. So you guys have a great investor base there, right? But if you come to San Francisco or Seattle, you're going to be competing heavily. There might be more dollars there, but the competition for those dollars is significant. And so that would be, and then the last thing I would say is the ecosystem there is beginning to flourish. So you have a, you know, Spokane, Northern Idaho, that whole piece I think is phenomenal. Your ecosystem, you have great investors like some of the people on this call that are willing to invest in your business. And so from my perspective, it's literally one of the jewels in the Western United States in terms of growing as an ecosystem. So the cons, there's got to be negative there too, Tom.
I think this meeting's about ready to be over with. Thanks, Cole. Appreciate your time.
I'll just throw a couple cons. You know, the ecosystem is relatively young, right? And so you're still growing in the ecosystem. So critical mass is maybe not quite there yet. What that means is that on the technical talent side, you got to get more people to move there. And so more specifically, if I live in Bellevue, Washington, and walk down the street, I probably bump into somebody that can code in the language that I need, and maybe even as a front end or back end, who knows? I can probably just bump into those people. In Spokane, there's more and more of that happening, but we want to see that continues to grow. And then lastly, the volume of dollars. So as the companies move there, and as there's more opportunity, more investors are investing there in that critical mass. That's just a matter of time. So that's my answer to your three questions, Tom.
Perfectly done. Perfectly done. And your response about Spokane is really very balanced, and I couldn't agree with you more.
I got one last thing, Tom. Sorry. Okay. One last thing. Sorry, my fault.
No, that's okay.
Pre-COVID, I want to add one pre-COVID to COVID comment.
Okay.
Before COVID, right, you had to go out and say, hey, we're Spokane, you know, well, am I in the hub? Should I be in Seattle? Do I need to be closer to what's going on? Now that I think I can speak for a lot of VCs that are I just looked at a company that was in New York, right? So you, in just as an example, you are in a situation where the remote work situation has just taken that out of the equation. So you being not in Seattle used to be something you had to overcome. Now, I think that's almost a non-issue from my perspective. So I'd want to make sure that I mentioned that.
How does the Spokane region, and I define that as kind of Spokane, Coeur d'Alene, and Sandpoint, get the word out better about our region? Because you do read these articles, but you know, Bozeman's always mentioned, Boise's mentioned, and you know, we're not as much as I would like. And why is that? And from your perspective, you know, what more could we perhaps be doing to get on the radar screen of those either individuals or tech companies or startups or entrepreneurs that may say, you know what, I'm tired in New York or the Bay Area?
Yeah. And I think this is a really straightforward one. It really comes down to the branding and messaging strategy that you guys use. And so you guys are doing phenomenal things there, but a lot of people don't know about it. And so when I say branding strategy, it's not only this is our strategy, we're going to tell everybody about what we're doing, and then we're going to keep telling them about what we're doing. So it has to do in the digital world, from my perspective. So when that one person bumps on to something online, they say, geez, I've heard about, you know, Spokane 3 times in the last month. I got to pay attention to this. And the only way you get that is by sometimes being super overt about the successes you guys are having. I think everybody there, not everybody, I think there is a tendency in Spokane to not tell the world about all the great things you guys are doing in a cadence that lets them know that it's really happening.
Yep. Great advice. And it's 1:02, and I've kind of promised everybody that we won't go too long. And there are no additional questions. So I have got a few comments here about what a great presentation this is and thanking you. So Cole, once again, thank you for doing this. I guess I do have one question. How do people get a hold of you if they're interested, if they've got a young business that might be eligible for seed or pre-seed financing? How do they find you?
Call Tom Simpson. His number's at the bottom of the screen. So no, they can always email me. I can provide that to Tom. So, but you can email me. You can give us a call. I can have all my contact information forwarded to Tom, or just email me directly is another way to go. So,
yeah. And I'd be happy to put anybody in touch with Cole. So with that, thanks again, Cole. Thanks everybody that participated. And I think this was a very enlightening session. So thank you.
Hey, thank you, Tom, for letting me come and speak. I actually really was looking forward to getting to talk to you guys. So thank you.
And hopefully we'll get you here in person soon once all the COVID and travel restrictions over with, and we can introduce you around to a few of the companies in Spokane that you may not otherwise know.
Excellent. All right, you guys have a great day.
Thank you.
All right.
Bye.